Some things that affect a company's stock price are out of its control. We still need to be aware of them, though. Being unable to control something and preparing for it are two different things. If you were to look at how stock prices behave during a recession, for example, you'd find a fairly consistent relationship. The S&P 500 declined during all 6 recessions between 1956 and 1987. If you move to more recent times, that pattern holds. The stock market fell during the 3 recessions of 1990 to 91, the early 21st century, and the so-called Great Recession of 2007. Every time that the economy has gone into a recession since 1950, stocks have declined significantly. That makes sense. The word recession connotes an economic downturn or contraction. The unofficial definition of a recession is 2 consecutive quarters of declining gross domestic product, more commonly called just GDP. GDP is the total value of the nation's production of goods and services. If a nation produces less, then people earn less and they buy less. Companies sell less and they earn less. Because stocks are claims on those company earnings, I'm not at all surprised that investors decide that they don't want to pay as much for those claims as they would during good times. Can we make money on this information? If we can predict recessions, then we ought to be able to sell beforehand and buy when the economy rebounds. Let's think about how we'd make that work. First, we'd need to be able to forecast turning points of the economy. Second, we'd need to sell before other investors see the recession coming. Third, we'd need to start buying again before other investors see the light at the end of the tunnel. We do have some reasonably good predictors of economic activity. The Conference Board Leading Economic Index, more commonly called just the Index of Leading Economic Indicators, is the best known. This index is a composite of about 10 factors, such as consumer expectations, initial unemployment claims, and new orders for consumer goods. The problem with using this to call market trends is that the information it uses is available to market participants who can make their own guesses and act at least as fast as we can. This means that any decline in stock prices as we head into a recession should begin before the recession. And in fact, that's what tends to happen. Stocks started declining before every recession since at least 1950. Investors see the economic contraction coming. Okay, you say, then why don't we just wait for stocks to signal a recession by declining and then sell before the onset of the recession itself? History shows that stocks have continued to decline after the recession starts, so we ought to be able to save some money. History also shows us 3 problems with this plan. First, since at least 1950, stocks have always declined during recessions, but every decline hasn't signaled an imminent recession. Cynical analysts like to say that the stock market has successfully predicted 16 of the last 9 recessions. This means that if we had followed our rule of selling after a decline, then we would have sold 7 times when we shouldn't have. For example, we'd have sold near the end of 2012 and missed a run-up of almost 40% over the next 10 or 12 months. Second, we don't have a good way to tell how long the stock market downturn will last. John P. Hussman, president of Hussman Investment Trust, has found that serious market declines, let's call them bear markets, that occur during recessions last longer than what he calls a standalone bear market. Hussman says that from 1950 to 2007, the 7 standalone bear markets lasted an average of 215 days. In contrast, the 9 bear markets that coincided with recessions lasted more than twice as long, an average of almost 500 days. Hussman says that these market declines tended to be more severe, too. But since we can't tell whether a recession will follow the stock price decline, we can't tell how long the downturn will last. That means that we can't tell when to get back into the stock market. Third, we haven't specified what we mean by a decline in stock prices. Do we mean, say, a 5% drop, or do we mean a 10% drop? Over what time period? Do we mean a 5% drop in a week, or a 10% drop in a calendar quarter? Lots of smart people have come up with different answers. The bottom line is that it's almost impossible to call stock market turning points at the right time, even if you can call recessions and recoveries with reasonable accuracy. We do know that these business cycle changes affect risk premiums on stocks. Donald Keim and Robert Stambaugh, writing in the Journal of Financial Economics, found that the difference between the yield on risky bonds and safe bonds signals higher expected stock returns. The idea is that a big spread between the yield of a safe bond and a risky one signals that times are risky. And we've already seen that stocks tend to return more during risky times. The timing of these economic forces driving these stories is a little tricky. Stock prices should fall at the onset of the increased risk, which is then reflected in higher dividend yields. Bond spreads widen. That's unexpected bad news, and stocks take a hit. But once investors are aware of the risky situation, stock prices have already fallen, and risk premiums have increased, then from that point on, we expect higher returns during the risky period itself. That might seem counterintuitive, but it actually fits. Stocks fall on the bad news that increases risk, but after the prices have fallen, the expected returns from then on are higher. Let's reverse the situation for practice. If investors see more normal times ahead, then they're willing to bid more for stocks. Stock prices rise, which is then reflected in more normal dividend yields, and risk premiums decline. From then on, during the safe period, we expect normal stock returns during the period of normal risk. International tensions or political uncertainty might increase risk premiums. That would cause a broad decline in stock prices. International tensions or political uncertainty are beyond the control of a company. It's just part of the risk of doing business. Being unable to make investing profits by observing the macroeconomy doesn't mean that it's a waste of time. You can do two things to help you manage your risk and sleep better at night. The first is that you might want to take a little money off the table when the market gets unsettled. Remember, you're managing risk by doing this, not trying to make a profit. If you're happy with the amount of risk you have in your portfolio and then the world gets riskier, then it's understandable if you feel a little uneasy and want to lighten up on your stock holdings. I know lots of smart people who do that. I also know lots of smart people who stick with their holdings when the world gets riskier. They don't make any changes at all. Instead, they focus on the higher expected returns going forward. Because they understand that the increased risk is likely to lead to higher expected returns, they're comfortable with that risk. They reason that risk itself isn't bad as long as they can expect to get paid for taking it. Either of these two approaches can help you sleep better at night. Some industries and companies are more susceptible to business cycles than others. If you think about it, then you'll get a feel for why. Let's take a look at two companies, Ford, the car company, and Colgate, the toothpaste company. How do you think these companies will be affected by business cycles? Let's get the bad scenario out of the way first. The economy isn't doing too well, your job prospects are a little shakier than they were a couple of months ago, and it doesn't look as if you'll get a raise this year. Your car's been causing problems here and there. Might be time to think about replacing it. Oh, and to top it all off, you're almost out of toothpaste. You need to come up with a plan to get you through this rough patch. What would be a reasonable plan? First, you could postpone getting a new car. Sure, you'll need to budget for repairs, but buying a new one just isn't in the cards right now. As for the toothpaste, my guess is that you're going to buy the toothpaste anyway. It doesn't cost that much, and you need it all the time, including right now. Compared to Ford, Colgate is relatively immune to economic downturns. Now that we've considered the bad scenario, the good one is easy. The economy is growing, your company is hiring, and you just got a promotion. Your car is still causing problems though, and yes, you're still almost out of toothpaste. In this case, you're much more likely to buy that new car, and you can see why Ford Motor Company shares tend to be so cyclical. Now about that toothpaste. With your economic prospects looking so good, you can afford to buy tons of toothpaste. But you won't. You're probably going to buy the same amount of toothpaste as you would in bad times. Yes, you can afford to buy more, and yes, you do need toothpaste all the time. But you only need so much of it. Toothpaste isn't like a car. You can delay replacing your car, and a nice new luxury model is a whole lot better than a smaller, plainer one with some wear on it already. Toothpaste isn't like that. Despite what the glitzy ads claim, toothpaste is pretty much just toothpaste. You can see why the toothpaste business is less susceptible to the ups and downs of business cycles than car manufacturers. Because it's safer, it tends to return less. Booms and busts are the bane of economies everywhere. Throughout the early years of the Republic, the United States endured its share of financial panics and bank failures. People weren't sure what to do. Tell the truth, we're still not sure what to do. But people did want an end to the instability. Congress decided that the U.S. needed a way to supply a lot of currency fast if demand for it increased significantly in a short time. Insufficient amounts of currency could cause a panic. In 1912, the National Monetary Commission presented its recommendations. Congress passed the Federal Reserve Act, creating the Federal Reserve System, and then President Woodrow Wilson signed it into law on December 23, 1913. The Federal Reserve System, comprising the Board of Governors located in Washington, D.C., and the 12 regional banks located throughout the country, was born. The Fed is the United States central bank. Most nations with well-developed banking systems have a central bank. In Germany, it's called the Deutsche Bundesbank. In England, it's the Bank of England. The Federal Reserve has three primary functions. First, the Fed system serves as the nation's banker. It's the banker's bank and the government's bank. Banks rely on the Fed to handle a large portion of the nation's payments. We take it for granted that when we swipe our credit card, the proceeds of the purchase will eventually end up in the merchant's bank account. When you deposit a check, you expect the proceeds to end up in your account, not someone else's. These accounts are unlikely to be in the same bank, and you probably don't even notice the name of the bank. The payment system just works, plain and simple. The odds are good that a Fed bank will handle the transfer of money from one bank to the other. The Fed's role as the government's bank is a lot like your personal bank account writ large. Very, very large. The U.S. Treasury has what amounts to a checking account with the Federal Reserve. All federal tax revenues go into this account, and all federal payments go out of this account. The Fed also handles the Treasury's security auctions and redemptions. The U.S. Treasury actually produces the currency in our pockets, but the Fed banks distribute it to financial institutions. The Fed also checks bills for wear and tear and removes damaged currency from circulation. What happens to it? Take a tour of a Fed bank sometime. If you ask nicely, I'll bet that they'll give you a small bag of shredded bills. The ones I have contain about $100 worth of shredded bills. The Fed has excellent shredding facilities. Don't even think about reassembling the currency. Second, the Federal Reserve System is one of the country's bank regulators and supervisors. Ultimately, the goal is a safe and sound banking system. The Fed does allow individual banks to fail now and then. That's okay. If a grocery store closes, you wouldn't lose confidence in food distribution, would you? No, you wouldn't. You'd just shop at another store. The banking system is no different. The Fed's job isn't to ensure that banks never fail. The Fed's job is to ensure that people have confidence in the banking system as a whole. More recently, the Fed has been charged with implementing laws governing consumer credit. You've probably heard of the Truth in Lending Act, or the Equal Credit Opportunity Act, or the Home Mortgage Disclosure Act. This casts the Federal Reserve in the role of law enforcement rather than banking or monetary policy. The Fed's roles in payments and supervision are usually done behind the curtain. It's like your appendix. Most people never need to think about it, and if they do, then it's because something went wrong. But that's not true of the Fed's third main function, which is devising and implementing monetary policy. Monetary policy refers to the Fed changing the supply of money in the U.S. economy. If money is plentiful, then credit is easier to get, and interest rates tend to fall. The idea is that this induces people and firms to borrow money, to spend, and to make investments. That should boost the economy. It's not that simple, of course. Lower interest rates affect the income of lenders, too. People who buy bonds and other debt securities have loaned money to the bond issuers. The lenders have less income when rates are low. That means that they have less to spend, and that slows the economy. Economies are complex, and trying to fine-tune them is a tough job. Moreover, economists have lots of different definitions of money. Not all economists even agree on which of them affects the economy the most. M1 includes all coins and currency plus demand deposits, which are mostly checking accounts. M2 adds savings deposits and certain small deposits with withdrawal restrictions, plus money market accounts not held by institutions, and some important bank funding tools. M3 is the broadest measure of the money supply. It equals M2 plus all large time deposits, institutional money market fund assets, and other larger liquid assets. Most people play fast and loose with language when they refer to the money supply. Most of the time, they don't say which one they mean, and usually it doesn't matter too much. Most likely, though, they mean M3. The Fed changes the money supply in three ways. First, the Fed can change the discount rate. The discount rate is the interest rate that the Fed charges banks on short-term loans. In practice, the discount rate is more important as a policy signal rather than as a way to change the money supply. It's a way for the Fed to tell the world where it thinks interest rates should be. The second way that the Fed changes the money supply is by changing reserve requirements. Like most countries, the United States has a fractional reserve banking system. When you deposit $100 in a bank, the bank only has to keep a fraction of that $100 on hand. The reserve requirement is usually around 10%. That means that the bank only needs to keep $10 of your $100 on hand and can lend the rest. If the Fed wants to tighten the money supply, then it can raise the reserve requirement to, say, 12%. That would mean that the bank would only be able to lend 88 of your $100 deposit, so credit would be tighter. In practice, the Fed doesn't change reserve requirements very often. It's less disruptive to conduct what people call open market operations. To increase the money supply, the Fed buys securities in the financial markets. That puts money into the financial system, increasing the money supply. You'll hear that the Fed injected reserves because the new money eventually goes into the banking system somewhere, and collectively, the banks have more reserves as a result. When the Fed drains reserves, it reverses the process. It sells securities from its inventory. Buyers take money from their accounts and send it to the Fed in exchange for the securities. That reduces the money supply. The Fed uses open market operations far more often than changes in the discount rate or reserve requirements. You might ask why the Fed tries to affect interest rates. That's because by law, the Fed has twin goals: full employment and stable prices. That boils down to asking the Fed to fine-tune the economy. That's a tough job, and many economists think it's impossible. These economists argue that fine-tuning interest rates away from market levels is just price fixing. Interest rates are the price of money, right? History shows that price fixing doesn't work very well for other goods and services, and they think it doesn't work with money either. These economists would rather see the Fed just set a rule and follow it. Under a system of monetary rules, the Fed would let the money supply grow a few percent a year and let interest rates settle where they may. You might be saying, as an investor, do I need to care what the Fed does? Yes and no. Yes, Fed actions absolutely do affect the economy and the stock market. Walker Todd is a PhD, JD, and research fellow at the American Institute for Economic Research who spent 20 years as a legal officer and later as a research officer at the Federal Reserve Banks of New York and Cleveland. Dr. Todd explains that the Fed's open market operations can have a measurable effect on stock market prices. Monetary tightening operations, which usually raise market interest rates, tend to reduce domestic activity and cause share prices to fall. Monetary easing operations, which usually lower interest rates, tend to increase domestic activity and cause share prices to rise. But no, you can't expect to make money by trading on Fed actions unless you can outguess the experts. The markets are really efficient with respect to Fed activity. Fed actions are supposed to be transparent and predictable anyway, so when the Fed acts, it shouldn't be a surprise that would affect market rates. It doesn't work that way in practice, of course. Former Federal Reserve Chairman Alan Greenspan reportedly once said, tongue-in-cheek, "If you understood what I said, I must have misspoke." Fed spokesmen are indeed more open than they were in decades past, though. The Federal Reserve is a great source of information about the economy and the stock market. All of the regional banks have good websites with lots of information, and most of them have at least one publication that you'll find helpful. If you're searching Federal Reserve Bank websites, look for links that say something like education or publications or research. You'll find all kinds of articles and videos. Some of the material will be too basic for you, and some, particularly the sophisticated research articles, will be too specialized and esoteric to be helpful. But you'll find plenty that you can use. I'm personally fond of the Cleveland Fed's Economic Commentary series. For example, you'll find articles like "Why Are Interest Rates So Low?" by Joseph Haubrich, written in 2013. You're busy, you want the main idea rather than a lot of detail, and you'd rather see a graph than an equation, right? Dr. Haubrich's article is just 4 pages, including figures, and he wrote it with people like you in mind. At the Atlanta Fed, you'll find economic and financial highlights, such as historical information on international trade or light vehicle sales. The Fed's research economists blog about topics ranging from banking to real estate to inflation. Give their site a look. Those are my favorite sites for articles, and the Fed system also offers data galore. Some of the data from this lesson are from FRED, for Federal Reserve Economic Data, produced by the St. Louis Fed. The last time I checked, FRED contained almost 150,000 economic data series. Exchange rates, inflation rates, stock prices, housing starts. Just about any data you want is there, and it's free. The stock market is also affected by what happens to foreign currencies. Not every country uses US dollars, of course, and changes in the value of those currencies in relation to the US dollar can influence the economy. For example, the countries belonging to the European Union use the euro as their national currency. The number of countries using the euro has varied over time. Now the figure is around 20, including major economies such as Germany, France, and Italy, plus a host of smaller economies like Estonia and Malta. You can buy foreign currencies just like you can buy foreign cars. And just like the price of foreign cars, the price of foreign currencies varies. People usually use the term exchange rates rather than prices for currencies. Since its inception in the late 20th century, the dollar-euro exchange rate has fluctuated from a low of around 0.85 to 1 to a high of around 1.6 to 1. Put differently, you could buy a euro for 85 cents in late 2000, but it would have cost you about $1.60 for that same euro in late 2008. In practical terms, that variation can affect U.S. stock prices. A BMW that cost 40,000 euros in 2000 would have cost you about $34,000. A BMW costing 40,000 euros in 2008 would have cost you almost double that, $64,000. Fluctuations like that can obviously affect a company's sales and profits. Determining how they affect sales and profits isn't as easy as it looks. A lot's going on behind the curtain. For one thing, BMW has to buy the components and parts for its cars. If the euro is strong, then it can buy those components and parts for less. That will either boost BMW's profits or let it lower its prices. After all, it's competing with Mercedes, and Mercedes is in the same position, so maybe that car that cost 40,000 euros before won't cost 40,000 euros now. Projecting sales and profits gets complicated fast. These days you can buy a BMW built in the United States, so the exchange rate doesn't matter as much. Lexus, Acura, and Infiniti are also competing, and the exchange rates between the yen, the euro, and the US dollar are in the equation too. Maybe that's why the link between exchange rates and stock prices isn't as strong as it might first appear. To take the S&P 500 and the US euro exchange rate as one example, you'll find that the S&P rose while the euro fell against the dollar in the late 20th century, and then the exchange rate stayed mostly flat or rose while stocks fell from then until about 2003. In 2003, the two began to move in mostly the same direction until about early 2012, when stocks continued to rise while the euro flattened against the dollar. And that's just one currency, the euro. The relationship between stock prices and foreign currencies is complicated. Using a single currency like the euro in multiple nations has good and bad points, and some of them can affect U.S. stocks. It's nice that a French baker near the border of France and Germany doesn't have to make a lot of transactions in both currencies, for example. Customers living in Germany don't have to worry about whether their German marks will buy the same amount of goods today as they did yesterday. Record keeping and billing are a lot simpler. To get a feel for the disadvantages of a single currency, think of economic problems as infectious diseases. If I live in Germany and you live in the US, then the odds of me spreading my flu virus to people who end up infecting you are a lot lower than they are if you live in, say, France. To infect you, the virus has to make it across the Atlantic from Germany all the way to the US. It can happen, but it's a lot easier for it to spread across a border that saw many thousands of people crossing each way every day. A common currency makes it easier for problems in one country to affect others. Most experts agree that problems in Greece, a relatively small economy compared to Germany and France, contributed to the length and severity of the European recession that began in late 2007. Normally, when a government runs big deficits, its currency falls relative to the currencies of its more frugal neighbors. That's because people understand that in the long run, the government will probably do what governments have done in the past: print more money to cover the bills. Creating more money out of nothing lowers the value of that money. But if one country overspends relative to other countries using the same currency, like the euro, then it can't print more of this common currency. The result is that economic contractions can be worse. That hurts international trade a lot more for countries using the common currency than it does with the United States. Still, the U.S. needs healthy trading partners, and if a huge economic area like the Eurozone coughs, then the entire world catches a cold. Sometime during the next few days, take a couple of minutes and go to the Fed websites and look for articles and data that catch your fancy. The National Bureau of Economic Research, or NBER, also has a good site, although sometimes that information on it is very technical. You can find a lot of information about currency trading and exchange rates online too. You'll find historical exchange rates, current exchange rates, average exchange rates for dozens of currencies over any number of different time periods, graphs, and news articles. In our next and final lecture, we'll look at some things you might want to do to make sure that you're comfortable with your decision to invest in stocks. It's time to take a closer look at your financial situation and decide what you want to do.